This is InvestTalk, independent thinking, shared success. Justin Klein and Steve Peasley stand ready to take your finance and investment questions and share their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Thursday, July 6th, 2023 edition. I'm Justin Klein, and I'm excited for this hour with you to help you become a better investor and impart some perspective that I've developed over the last 20 plus years of investment experience and some data, which I have a lot in front of me, a lot of professional tools that I can pull up quickly and get a good synopsis of different companies and different economic data points, things like that, that I will use and blend with your questions and the topics that you bring to the table. So you set the table, you set the agenda for today's show. And of course, we don't pre-screen our live calls. We take what you throw at us, and that's what we are here to do. No hidden agenda, just help encourage you to weed out the counterproductive habits that many people have, and especially newer investors. And it's one of the hardest things to break are those natural instincts of chasing headlines and embracing your emotions and letting those emotions create your decision making. And that's what we are here to do, is help you break from that mold and become more like professional investors, right? Who don't chase returns and can have a consistent, productive strategy over the long term. So the InvestTalk phone lines never close. 888-99-CHART is how you get through and ask your question on today's show. Now, my main focus point looks in the story behind this question. Does the labor force need more out of office time? And this is a new trend in the workplace, and we're going to dig into some data to see if this is a worthwhile trend or it's holding companies back. So we're going to look at that. In addition, I have some other topics to discuss. One is in regards to home builder stocks, and I wanted to give you a primer or an overview of what's happened over really since the start of the year in that sector and why it's been so strong. Also, Americans aren't quitting their jobs as much as they had recently. What does that say for the job market going forward? And then lastly, the U.S. is still the top investment destination, but are the overall flows starting to slow? So we're going to look at some numbers there. I also have some voice bank questions to go over. One is in regards to stocks and taxes and Netflix. And of course, I have this all planned for today's episode of InvestTalk, but most importantly, your live calls will always come first at 888-99-CHART. So don't hesitate to dial that number and ask your question if you're listening on the live stream or even after hours. We'll answer it on a future show if you leave a message. Now, how did the market do today? Well, it was certainly a red day across the board. And really this was on the back of the ADP jobs figure that came out today that blew away really all expectations. And what was interesting is that there are other data points that in the jobs market that weren't nearly as strong. Right? The ADP employment change was nearly 500,000 jobs. Previous month it was 267,000, and the jobs number that comes out tomorrow is supposed to be right around 200,000 jobs created. So this 500,000 really was an indication that tomorrow's number will beat, and the market kind of reacted to that. Now, the ADP jobs numbers are pretty noisy, so I try not to put too much stock into it, but obviously the market certainly did. Now, an actual government number, remember the ADP is something that's put out by ADP, a private company. The government statistics that came out today, the initial jobless claims for unemployment insurance, that actually ticked up from 236,000 to 248,000. So that indicated that no, the jobs market isn't getting materially stronger. In fact, it's actually getting incrementally, not majorly, incrementally a bit weaker, at least based on that number. You also have the ISM services index that came out today. Now, the employment index did tick up. Now, that was one indicator that certainly showed a bit of strength from shrinkage. It was below 50 last month, and now it's above 50, 53 in this current month, or I guess you could say in June. But the overall new orders ticked up. You had the PMI tick up from 50 to 53.9. So there's certainly some strength there as well. And, in total job openings, that actually ticked down. So I think it's more of a mixed bag. But obviously the market reacted negatively. Small caps were down about 1.36%. Large and mid caps down around a little less than 1%. So this was a weekday on the expectation that the Fed is going to get incrementally hawkish due to the economic data. But we'll get more economic data tomorrow, a big one, right? The jobs number, and more coming into going next week. I believe we have inflation data next week as well. So I said yesterday on the show, I wouldn't be surprised if I see a short-term little pullback here, and so far that's what we have seen. Now let's head over to our first listener question now.
Hey, this is Craig calling from the mountains outside Seattle. Looking at the energy sector, and I'm curious your take on ticker symbol SM. I would like to understand how it's evaluated and why. I have a very small position, about 100 shares. But as things go down, I want to know whether or not it's worth buying more. So look forward to your feedback. Thank you. Bye-bye.
All right, this is SM Energy. It's an independent energy company, does exploration and production, development of crude oil and condensate, natural gas, and natural gas liquid. So it's a smaller E&P, only about a $3.6 billion market cap. And it yields a dividend yield right around 1%. So not a big dividend payout, but it could easily raise that based on what it's earning right now. So I could see that dividend going up. So I like that. Enterprise value to EBITDA is 2.1%, very, very low for a name like this. These type of names do trade kind of low multiples versus the larger names, which tend to trade more like 4 or 5 times enterprise value to EBITDA right now. This one's closer to 2. So compared to those larger names, it's cheaper. But then maybe it should be, right? Because it is smaller. Now, the technicals are, I would say, neutral, very similar to the broad energy complex as a whole. Now, if you look at this compared to some of the larger names, it's really been, let's see, let me pull back a larger chart here. Yeah, it outperformed when energy prices really went up. So this is going to have a much higher beta to the energy sector as a whole, meaning if energy does well, this will do probably even better than the average stock and vice versa. So I kind of like it. I kind of like the profitability. It's certainly a much higher risk than you see with the Exxons or the Chevrons, mainly because they're just a straight E&P company. They don't have the refining business, the chemical business like those larger names have. Historically, their profitability ebbs and flows with the overall industry. So it's certainly not a name that I put in a drawer and forget about, but it's a solid company at reasonable valuations, trading at about 5 times forward-looking earnings. Once again, room for that dividend to grow. I like that. So I'm going to give SM Energy a thumbs up, but understand it is much higher risk than your typical large cap E&P company, exploration production company within the oil space. Now we're going to a quick break. Please remember that you can call anytime and leave your question on the InvestTalk voice bank, or if you're listening via the live stream on AM 1220 in Silicon Valley, you can call right now at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
the caller voices are amplified many thousands of times.
Just wanted to get your opinion on JPMorgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Food, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART. The stock market is constantly changing, and now with more than 50 million downloads, Justin Klein and Steve Peasley reaffirm their commitment to providing unbiased finance and investment guidance here on InvestTalk. 888-99-CHART.
Hello, Justin or Steve. My name is Daryl. I'm calling from California. My question's about Netflix, and just wondering if it's a good time to buy. Again, that's Netflix, NFLX. Thank you very much. Bye-bye.
All right, taking a look at Netflix, and this has had a major comeback from its lows in the fall. Sorry, just pulling up this chart here. And the lows were right around $150 per share. 170. Yeah, there you go. 170 was the 52-week low. And the high was right on $700 per share. So quite the drop from $700 at the end of 2021 all the way to a low in, let's see, when was this? Actually, it was summer last year when it hit its low, and then it's rallied all the way to $438. Now here's the deal with Netflix. They have a very sticky business, but it's a business that is capital intensive, meaning that they need to spend a lot of money on the production of new content. And they've had some major hits, right? What's the Stranger Things? They've had a few more, major hits, but they spend a lot of money on content. And they actually did very well during the pandemic. Why? Because they actually had to stop producing as much content. Right? It was just more difficult because of work from home environments and COVID policies, et cetera. And that's where they went from $4 a share in earnings in 2019 all the way to $11 in 2021. Last year, it retrenched to $9.98. And their cash flow certainly suffered. So their free cash flow went from $2.5 billion all the way down to negative at the end of 2021. And then all the way back up to $3 billion recently. So the longer term trend, I think, is positive, but you're paying a very high multiple. Price sales right now around 6 times, enterprise value to EBITDA about 10. Would it say it's a good time to buy it? No, I don't love their long term ability to produce quality content. They've spent a lot of money, and they only have a handful of hits to really show for it, compared to like an HBO, who's been doing it a long time, and they have hit after hit after hit, and their value there and their expertise is certainly valued. So I don't think this is a good time to get a Netflix after this run. I don't find it to be a great investment at these prices. All right, let's go to Mike in San Jose. Let's talk about 3M again.
Hi, Justin. How are you?
Good.
I don't know if someone else asked the question. I bought it a few months ago at around 105, and then I was wondering, should I just cut my losses or just hang on to it? Because I have some lawsuits problem with the headset that they had. Mm-hmm. But it pays like a 6% dividend. I don't know if that's... well, this is exactly something. We had a call yesterday on 3M. So I talked about it then, and it was, I'll give you the same answer, which is the litigation issues hanging over its head just create way too much uncertainty around their valuation and their business. And their business is not doing hot either, with 4 quarters in a row of negative sales growth. And
4 of the last 5 quarters of negative earnings growth. And then you add top of the litigation issues, top of that, the debt issues. The 6.2% dividend yield is irrelevant if you're just losing, 15, 20% a year in price depreciation of the stock, right? So once again, never focus on the dividend. Dividend is, I don't want to say dividend is irrelevant, but it's very low on the list of variables that you should be considering when you're trying to own a business. That's what you're doing here, right? So when you're buying a stock, you're spending ownership. You're buying ownership in the business, and there's too many things overhead with 3M that just makes me not want to own it at this time. Certainly one on your watch list to see if these issues kind of get cleared up, and maybe it's one to jump into. But at this time, the technicals, the fundamentals, and the litigation problems are just too heavy, and it's not something that I would own. Now we're heading into a break. I welcome your finance and investment questions now. So give InvestTalk a call at 888-99-CHART.
Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Now, my focus point today looks into the story behind this question. Does the labor force need more out-of-office time? And for many workers, it's a challenge to disengage from the office. And more than 55% of the U.S. workforce says they don't fully unplug from their job. And this is really interesting because 17% say they stay fully connected away from work. And this is one of, I think, the downsides of the whole work from home environment is not only the discussion I had, I believe it was earlier this week or last week, about how it's hard to create a good culture, good corporate culture, when everyone's working from home, and that kind of FaceTime, I guess, pun intended there, is important to collaboration and engagement with your colleagues. But it's also, when you work from home, you're kind of always thinking about what your job may entail and what things you need to do. Because when you go into the office 5 days a week, oftentimes that's your line in the sand. And it's, okay, when I get in my car and I go and drive in the office, that's the transition time. And people underrate that. It's transition time between your home environment and your home mind to your work switch, right? That's switching over to your work mind and focusing on that. And oftentimes we don't get that when you're working from home. That's why I know I walk the dog in the morning, and that's kind of my delineation that, okay, the morning is done, and now I'm transitioning now into work mode. The days at least that I'm working from home. So it's not a shock to see that it's difficult for employees to really disengage fully from their job, and that they need more true vacation time where they're truly unplugged, and that helps reduce employee burnout. Employees report overall mental health, increased job satisfaction, and being more engaged and productive when they do return from vacation. And, previously it was the pay for performance culture, and that's really driven a lot of companies here in the US that, and it's negatively impacted a lot of performance by employees because of that pressure, and not enough time to fully take away from work. So obviously it's about how do you truly disconnect, right? Having people that can make decisions in an absence, knowing that if there is a major problem that they will reach out to you, they know where to contact you, but otherwise you can fully disengage. Now, 84% of employees surveyed say remote work makes it easier to get away on a day-to-day basis. But like I said, it makes it harder to fully unplug. So I wanted to highlight that because it's really interesting to see how this is evolving. And this is one of the biggest secular trends probably of our lifetime. Just think of how much the lives of the office worker has changed since the pandemic, and what type of impact that has on the population. You talk about migration to different cities or out of different cities. And then the impact on the broad economy and the companies within that economy. It's so important to follow and understand where this is headed. It's still, I don't think it's fully understood where exactly it is headed because there's so many studies. Some of them are conflicting. Some just haven't been done yet to really see what makes sense holistically for the worker, for the companies as well. So very interesting to follow those trends. Now let's pivot back to the InvestTalk Voice Bank. This came in earlier on 888-99 chart.
I'm just wondering what you think about Lockheed Martin as far as next 2 years from now, 5 years from now, 10 years from now. I appreciate it. I'll be listening for an answer. Thank you.
Well, we're getting a lot of repeat questions. I feel like I answered this yesterday or the day before. And, Lockheed is within that aerospace and defense business. And this stock has really traded sideways for the better part of a year and a half now. Earnings growth has basically gone flat. And I don't believe that over the longer term, you're gonna get the same type of spending on military as you have over the past 50, 60 years. I think most Americans can agree that the military industrial complex is probably a bit out of control. There's a lot of overcharging and overspending. And our endeavors into global wars and global policing we probably more overstep our boundaries than not do enough, right? I think most people would agree with that. And then you add on top of that the amount of debt that we have and the part of our budget that is going towards defense, and now the part of our budget that is going towards interest. We're going to have to, if we're going to keep paying that interest, we're going to have to start crowding out some other types of spending. And I see more fiscal spending on infrastructure. Just look at the Inflation Reduction Act and the CHIPS Act that was passed last year. More industrial policy that will be more the focus of government spending. And I think start to crowd out a lot of military spending. So I don't see Lockheed being a fantastic investment at this time. I just think there's better opportunities. All right. Now, in the next Invest Talk, we'll look into this question. When should you own the underlying components rather than the fund of funds? You could save on fees, but the do-it-yourself approach could be more trouble than it's worth. Steve will get in that story tomorrow, but for now, I'm Justin Klein, ready to take your questions live at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Let's talk about housing stocks. And some of the largest builders, Pulte is up 70% this year. D.R. Horton and Lennar are both up more than 30%. Now, disclaimer, we've owned Pulte for a while. It was our favorite for a while for mainly the reasons that they focused on the South, but they're broad-based. But they're clearly outperforming this year, and to a lot of people's surprise. But if you look at the data and you don't follow just the narrative that higher rates are bad for quote unquote housing, then you'll understand exactly why. And the newest data on the housing market makes it even more advantageous for the home builders, meaning new listings in May of existing homes decreased by 25% from the previous year. Decreased. It was the sharpest decline on record, well, since May 2020, since the pandemic. But nationally, there are only 1.08 million existing homes for sale or under contract at the end of May. In May of 2019, pre-pandemic, there was nearly double, 1.91 million. New home sales as a percentage of home sales went from 15% in early 2018 to 19% this year. And the largest builders are the ones that are benefiting the most. The top three publicly traded ones, D.R. Horton, Lennar, and Pulte, have seen their share of new home sales rise from 22% to 31% over the past 5 years. So the big ones with the ability to actually get supply out there, they've been benefiting the most. Last year, a lot of them were still dealing with supply chains. And this is where being large and having a lot of experience allowed these three companies to capitalize the most, because they knew how to deal with supply chains that were tight. They have a lot of suppliers they can pull from. If one goes out or one's short, they can turn to another to find the products that they need to put into their homes. Now, generally, the largest home building markets are in South Florida and Texas, and those markets are benefiting from major corporate trends, relocation, and a very strong jobs market. In addition, retirees are looking to move to those places as well. Why? Low taxes in those states. The 55 and older communities are going like gangbusters because so many retirees are selling their homes in expensive markets and trading, quote unquote, down, cashing out a lot of equity and buying in these 55 and older communities in many of these southern and Midwest markets. Now, new home sales were up 12% in May from the previous month and 20% year over year, while existing home sales in May were up only 0.2% month over month and down 20% year over year. Now, this time last year, home builder stocks were in the gutter. For somewhat good reason, National Association of Home Builders showed that home builder sentiment fell in a big way last year. And around this time last year, home builder stocks were down about 20% on the year. And this goes to show you that chasing that performance is oftentimes the worst way to go. It's about understanding where sentiment is and getting ahead of it. And often it's the other way as well. When you're in a position, this is the time where we're actually trimming our Pulte holding. We're cutting back. We're taking profits. When you see these articles that are coming out and everyone talking about the great performance, that's usually the time you want to be thinking about lowering risk in that area, not taking more. Now let's swing back to the InvestTalk voice bank at 888-99-CHART.
Hey, Stephen, Justin, Bill from Virginia here. I got a tax question. So say that I buy a stock, put $10,000 in it, and eventually it goes to $20,000. If I pull that initial investment of $10,000 out and sell, is that taxable, even though I'm pulling the original amount that I invested in and there's essentially no capital gains? Just a little confused in that aspect of things, and looking forward to hearing your answers. Thanks so much.
Well, I'm assuming you're talking about a taxable account, taxable brokerage account, and the answer is you'd be taxed 50%. So you can't just take out the initial and not pay on the gains there. There are some things like a DST that we talked about in our webinar last week for highly appreciated assets, meaning if you have capital gains of 7 figures plus, there are ways to defer that and pull some money out, et cetera. But if you're just talking, low dollar amount like that, 10,000 that turns into 20,000, you sell half of it. Well, that means you're going to sell half your shares. And so your cost basis on half those shares is not 10,000, it's 5,000. And you pulled out 10, so you're going to pay taxes on 5,000 that you've pulled out. I hope that helps. Pretty simple there. And yeah, it's just selling particular lots, and you have to figure out which lot you want to sell. Maybe you have one purchase, right? You bought that 10,000 and one buy. that's one lot. Maybe you bought it over various time frames, maybe 2,500 each over 4 different purchases. Then there's different lots that you can choose based on your broker, which one you sell, etc. All right. Now let's play another question now.
Hey, Steve and Justin. This is Mike calling from Detroit. I wanted to increase my exposure to the natural energy space as an next addition to my portfolio. I came across 2 stocks that I was looking at, Occidental Petroleum and Devon Energy, DVN. Wondering which one you would pick. If it came down to it, should I add a little bit of both? Are these good prices to pick them up at? Let me know your thoughts about the companies, please. Appreciate everything you do for us on the show. Thank you very much. Have a good day.
All right, looking at Occidental Petroleum and Devon Energy. We had a question on Devon Energy yesterday compared to another name, but let's look at Devon Energy compared to Occidental. Now, Occidental's kind of been in the news as of late in regards to Warren Buffett buying a lot of shares of Occidental. Now, these are both very large companies. Occidental has about a $51 billion market cap, Devon Energy about a $30 billion. So definitely both in the large cap E&P space. Let's see, Oxy, I know they were more shale related, but they are more worldwide. Once again, larger $50 billion market cap. Both have a decent amount of debt. Oxy, they almost went bankrupt during COVID, and because they had a lot of debt, they've obviously paid a lot of that down. Luckily, they've gone from, $47 billion in debt in September of 2019, all the way down to $19 billion now. So they've used a lot of that cash flow to continue to pay down debt. I like that. Their dividend yield is pretty high. But it looks like they've cut that dividend. Yeah, let me see this. Oh, actually, never mind. Yeah, that's actually low, only 1% yield, whereas Devon pays a higher dividend yield. But Devon also has a good amount of debt. Their longer-term profitability is weaker. And so I'm going to say, if I'm picking one or the other, I'm going to go with Occidental. I like the diversity of their business worldwide and the fact that they are bigger. All right. So I'm going to take Occidental over Devon Energy. Remember, don't chase that dividend, chase the business. And Occidental just has a better business. All right. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now let's take a look at some recent job data, not just the amount of new jobless claims that was reported today, but also quitting. Americans voluntarily left 4 million jobs in the month of May, according to the Labor Department. This was reported on Thursday. Actually, reported today. Yep. And it dropped. That's a drop from around 500,000 from 4.5 million in November of 2021. That was the highest level of quits. And the quit rate has averaged 2.5% from March to May. That's down from 3% as recently as April of last year. It's only slightly higher than pre-pandemic levels. And I think that's important right there is it's come down, but it's still above pre-pandemic levels. And the quit rate is an indicator of really the strength of the jobs market, because you're not really going to quit your job if you don't feel confident that you're going to go find a new one. Most people quit their jobs because they're ready to step right into another one. And so if they don't have those opportunities, it's pretty clear that the jobs market is weakening. And there's probably a few reasons for that. Once again, jobs market weakening. Also, I think employee pay has gone up. And so people are happier. There's been more benefits, more vacation days often that many employees are getting. And certainly that's one reason why they're happy with their job. Also, I think another is inflation. The fact that inflation has started to come down. If you look year over year, it's still 4-ish%. But if you look more over the past 6 months, it's more like 2.5% back to what we've kind of been used to. And so if your pay has gotten that nice boost, but you're not feeling the effects of inflation as much, your real wage gain has been pretty good. And so you have less reason to go and search for a better job. So really interesting data that came out along with some of the other employment data. And yeah, I wanted to highlight that. But underneath the surface, job market still weakening modestly. Let's go to Nick in Manhattan Beach. He wants to talk about AWEVF. Is that what it is?
Yeah, it sort of depends on your brokerage. It's listed on the London Stock Exchange.
Okay.
The company is called Alphawave Semi.
Mm-hmm.
I gave you a call, Justin, about them in January, I believe. I started buying shares then. It's a relatively new company. It's a sort of a quasi-intellectual property vendor and also a custom silicon company. It's fabless in the semiconductor space. And they have certain leading-edge products called serial deserializers, which are key components of chips used in data centers in particular. And they sort of help the mass transmission of bits of data from chip to chip and also within the data center from the networking boxes. They sort of make the flow of data more energy efficient, more speedy, generally things that the hyperscalers, the data center companies would be financially very interested in. Their business has been booming. The market, there's a very sort of a significant short report on them. It sent the stock down about a year ago. It had a very poor 2022. It's since been rebounding. I was wondering your take on the financials because they're a little hard to understand, and I was wondering if your platform gave you good insight into the financials and what you thought about them. Thank you.
Yeah, these foreign names, they often can be difficult to find good data on. Let me try to pull up another piece of software that we have that often has some pretty good data.
Fidelity is terrible.
Yeah, well, the foreign names, they don't have the listing or the reporting requirements like our exchanges, right? So, and most of the data providers, they're the ones that are getting the data, right? They have relationships with NYSE and the NASDAQ, and they're the ones that are getting this stuff. And it's often very difficult or inefficient for them to go overseas and gather a lot of data from them. So let me pull up this other one. So I'm not getting quite as much as I would have hoped. But let me just say what I do see is a company that it sounds great, but it doesn't seem like they're able to create a lot of profitability from this IP as of yet. Let's just say that. Sales this year are expected to go up dramatically, up 100 and let's say, this has been growing dramatically, but its overall profitability has still remained negative. Let me see, shares outstanding has been flat. That's good. Actually, no, shares outstanding just recently went up. Free cash flow is still negative, mainly because of CapEx spending. Their net operating cash flow is hovering around positive, which is okay, but they're having to take a lot of it and issue more shares in order to spend on CapEx. And I don't know what that CapEx is. Are they building their own fabs, or what is it that they're spending this CapEx on? So it's an interesting name. It sounds like you work in the space, Nick?
Yes, I do.
Okay. So you clearly know the value of this IP, but what type of broad application is it really going to have? So far, it doesn't seem like it's having at least a broad application that's incrementally positive for profitability. They've been struggling to remain positive over the past 5 years. So it's a very mixed picture on the fundamentals, and that's why I wouldn't put a whole lot of stock, should you say, in the recent move. Although, you're starting to find some positive momentum, and that's probably the best I could say out of this is a lot about the IP, you're confident in it, the technicals are starting to line up, the fundamentals are okay, but not great. So having a small position in this, I wouldn't mind it. All right. Well, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday is help you achieve your own version of financial freedom. And our work continues after this final break. James from San Jose, hang on. We will get to your question next on InvestTalk. 888-99-CHART.
day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Let's go talk to James in San Jose. Wants to talk about JPMorgan.
Hi, James. Hi, Steve. Question for you. I'm looking at the money market funds offered by JPMorgan. There are roughly about 8 or 9 of them.
Okay.
I'm debating whether I should pick one of them to put my money in from when my CDs mature next week, or if I should pick 2 or 3 money market funds, and if so, which ones?
So why would you want to spread out them amongst the money market funds?
Risk. I don't know if there is just to distribute the risk. I mean, if I was to pick one, then which one would it be? I think there are like 3 of them which are returning about 5%.
Let's see. I don't have, different share classes. Let's see. I'd have to take a look at these. I don't know them off the top of my head. I don't see any reason why you'd want to spread them around too much. I don't see any real reason for that. I'd have to look at them. Let's see, agency. There's different ones here. There's not much risk, I don't think, in money market funds. Now, one thing you have to consider is you're talking about going from CDs to money market funds. Understand that 5% that it yields today, it is not guaranteed to yield that 3 months from now, 6 months from now, a year from now. Know that. Money market rates are floating, right? They're investing in short-term securities. Most of these securities mature in 2, 3, 4, 6 weeks, right? These are almost all very, very short-term instruments. And so going from a CD where you're getting X percentage over X time frame, that's a different endeavor. So I would say that unless you have this money earmarked for something, right? What's this money earmarked for? Are you using it to buy something, or is this more just an investment?
To buy real estate maybe in the near future.
Oh, in the near future. Okay. Well, if then that's the case, then that makes sense, right? Because you don't want a loss of principal, but you also don't want to lock that money up and have some sort of penalty if you want to cash that out. So that makes sense. And so, but I wouldn't feel the need to spread them out. I think all of them are going to be very safe, especially near term. Okay. Thanks for the call. Now let's head over to some data in regards to foreign investment flows. And foreign investment in the U.S. fell to $285 billion last year. That's from $388 billion in 2021. And a lot of this is because of a sharp fall in foreign purchases of American companies. Now, there's probably 2 reasons for this. One, strong dollar. I think it's number one. When the dollar is strong, foreign investors, foreign countries becomes more expensive to buy assets here in the US. And then on top of that, a lot of the names, large cap names that are domestic companies, they fell in price in a big way. And so a lot of them were scared off to put more money as the Amazons of the world, the Googles of the world were falling 30, 40, 50%. Now, globally, new overseas investment by businesses did fall 12% from 2021 to 2022. So this was kind of a broader trend that countries were investing in other countries less last year. A big reason that is higher cost of capital as well, right? It's more expensive to borrow money to go and put a new factory in, buy another company, etc. That drop made last year the worst year for foreign investment since 2009, if you exclude the 2020, which was obviously skewed by COVID. Now, what you can say is, based on all those factors I talked about, it was actually more resilient than would be expected. In the UN, you actually saw a rise in investment there. Once again, currency fluctuations. So interesting trends, but overall, I think it was pretty resilient that the rest of the world is still investing in America. I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program,